Hey guys, welcome to my channel Accounts Accuracy. In my previous video of admission of partners, I had discussed regarding new profit sharing ratio among the partners, revaluation account as well as partners capital account and balance sheet. Here just see the treatment of goodwill on admission of a partner. The goodwill is an intangible asset and is recognized in the books of accounts only when the consideration in money is paid for that. Suppose the goodwill is internally generated by the partners, then in that case, goodwill is not recognized in the books of account because it is subjective to the value. So there are few conditions, but at the time of admission or retirement of a partner, if any partner brings premium for goodwill, then in that case that gets divided among the old partners in the sacrificing ratio. And there are 9 different situations in which the accounting treatment of goodwill is done on admission of a partner. First one is when the premium for goodwill is paid privately. Then in that case, remember, no entry is passed in the partner's capital account because it is paid privately, so they need not reflect it in their capital accounts. Next situation is when premium for goodwill is brought in cash or by check, then in that case, remember that is shared among the old partners in the sacrificing ratio. Just see with an example, A and B are the two partners sharing profit and losses in the ratio 2:1, and they admit C as a partner who brings 24,000 for his 1/4 share of goodwill. Now what we are noticing here that this 24,000 is the premium for goodwill brought in by the new partner C, and this should be divided among the old partners A and B in the sacrificing ratio. Here as the new ratio is not mentioned, so the old ratio will only become the sacrificing ratio. So 2:1 is the ratio in which 24,000 should be divided. So you will show in the partner's capital account as by premium for goodwill 16,000 and 8,000. This is how you should divide premium for goodwill and reflect in A's and B's old partner's capital account at credit side. Now next is your premium for goodwill brought in kind. Instead of cash, premium for goodwill has been brought in kind by the new partner. That means assets has been brought in place of cash. Here the new partner C for his 3/13 share has brought stock, debtors, land and building, plant and machinery in place of cash. So all these assets will be debited and C's capital account will be credited because in place of capital he has brought all these assets to the company. Again, it's also been given that goodwill of the firm was valued at 10,40,000. So 10,40,000 is the total goodwill of the firm. So we need to find out the goodwill share of new partner, that is 3/13th share of this 10,40,000, because this is the total value of goodwill of the entire firm. So for this you need to find out C's share of goodwill, that is 3/13th of 10,40,000, which would come 2,40,000. So for finding out sacrificing ratio, we need to deduct new ratio from the old ratio. New ratio is 5:5:3 and old ratio is 3:2. So for finding out the sacrificing ratio, we need to deduct new ratio from the old ratio. Old ratio is 3/5 and new ratio is 5/13. So from 3/5 we need to deduct 5/13 and we get the new ratio as 14/65. Again, the old ratio of B is 2/5 and new ratio is 5/13. So from 2/5 we need to deduct 5/13 and we get the sacrificing ratio 1/65. So the sacrificing ratio of A and B would be 14:1, and that is how premium for goodwill will be allocated among A and B in the ratio 14:1. That is 14/15 into 2,40,000, that would come 2,24,000, and for B it would come 1/15 into 2,40,000, that would come 16,000. Now the next one is premium for goodwill is brought in cash or check by new partner and is withdrawn by sacrificing partners either fully or partly. So let's understand it with an example. Suppose A and B are old partners and their old ratio is 2:1 and when new partner brought 24,000 for 1/4 share, here the premium for goodwill will be withdrawn by the partner. So here premium for goodwill, first it will be divided among the old partners in sacrificing ratio, that would come 16,000 and 8,000, that is in 2:1 ratio, that is sacrificing ratio, although it's old ratio, but as there is no information regarding the new ratio, so old ratio only becomes a sacrificing ratio. So in this sacrificing ratio 2:1, we will divide 24,000 as premium for goodwill among A and B, and here it's been mentioned that A and B withdrew premium for goodwill. Entire money has been withdrawn by the old partners, so that will be debited to their account because they have withdrawn the entire amount of goodwill, that is 16,000 and 8,000. At credit side, it will be reflected as buy premium for goodwill, and the same value will be reflected at debit side to bank account 16,000 and 8,000 in old partner's capital account. The next one is new or incoming partner does not bring his premium for goodwill in cash. In place of premium for goodwill, we need to write by C's current account because it will be raised from C's current account. The same value 16,000 and 8,000 will be reflected because I have not changed the question, only this thing has been added that C is unable to bring his share of goodwill. Simply the question is same, so amount will definitely remain same. The only thing you have to notice that in place of premium for goodwill, you need to write C's current account. Now the next case is the new partner or incoming partner could bring only a part of his share of premium for goodwill in cash or by check, but the rest of the amount he could not bring in cash. You can see here with an example, suppose A and B are the partners sharing profit and losses in the ratio 2:1, and they admit C for 24,000 of goodwill. 4,000 minus 6,000 is 18,000. He could only bring 6,000, rest 18,000 he is unable to bring in cash. That you need to raise from his current account. So you will have to allocate 6,000 in sacrificing ratio among A and B in the old partner's capital account, and rest 18,000 will be raised from new partner's current account, that is C's current account. And again 18,000 will be divided in the sacrificing ratio, that is 2:1. So 18,000 into 2 by 3 is 12,000 and 18,000 into 1 by 3 is 6,000. And here 6,000 which has been brought by new partner in cash will be reflected as 4,000, that is 6,000 into 2 by 3 for A, that is 4,000, and 6,000 into 1 by 3, that is 2,000 for B. So this is how you will reflect the amount which has been brought in cash will be premium for goodwill, and the amount which he could not bring in cash will be reflected as C's current account. Now the last case is hidden goodwill. For hidden goodwill, you should understand what the net worth is. So net worth is goodwill plus capital of the firm. Capital of the firm means the capital of all partners of the firm. So the net worth is the reciprocal of the share of new partner into incoming partner's capital account. Let's understand it well with the example. Suppose R and S are the two partners with capital 1,60,000 and 1,20,000 respectively. They admitted M for 1/4 share of profit in the firm. M brings 1,60,000 as a share of capital but is unable to bring any cash for goodwill. Goodwill is to be calculated on the basis of M's share in profit and the capital contributed by him. So what you are noticing here, the new partner M has been admitted for 1,60,000 as capital, and he has been admitted for 1/4 share of profit, and he brings 1,60,000 for his capital. So that is why the total worth of the firm will be reciprocal of 1/4 share, that is 1,60,000 into 4. So reciprocal of 1/4 share of profit is 4. That will be multiplied with the capital value of the new partner, which will give us the total worth of the firm, that is 6,40,000. Because the total worth of the firm is the capital plus goodwill value, and as the new partner has brought 1,60,000 for his amount of capital, so this value is also including the goodwill which he has brought for the entire firm. So for entire net worth, we need to multiply it with the reciprocal of his share of profit. So as we get the total worth, then we need to deduct the total capital of the firm. That means 1,60,000 plus 1,20,000 plus 1,60,000. So total of three partners capital is 4,40,000. So this 4,40,000, when we deduct from net worth, we will get the hidden goodwill of the entire firm, that is 2 lakh. So this 2 lakh is the hidden goodwill of the entire firm. So after this, you would be easily able to calculate the goodwill of new partner, that is 1/4 of 2 lakh. That will be 2 lakh into 1 by 4, that would come 50,000. I hope the video might have helped you. Please don't forget to subscribe my channel and hit the big fat like button. Thanks for watching.